Anatoly, it's my pleasure to welcome you to Real Vision. It's been a long time in the making. I think you and we've started talking about 4, 5, 6 months, something like that ago. And that's because we both have a common and joint interest in Bitcoin and digital assets. So we were talking professionally from a business perspective, and I thought it would make sense to get you onto Real Vision because I find your story fascinating. I find your firm fascinating. So first of all, let us know, who are you? Where do you come from? Why did you start the firm that you have started? And what do you do?
Thank you. It's a great pleasure to be here. And actually, there's 5 months since our first communication. Certainly, there are so many things happened that we can now discuss our original vision, where we are today, what is happening. So my name is Anatoly. I'm Russian by origin. Come from mathematical. One side of the family is mathematicians, other side nuclear physicists. Moved to London 20 years ago on the way to the US business school, but stopped for a couple of years, and then London became home. So did my master's in Oxford and worked for the last 20 odd years in the financial sector here in London. Most recently for the last 7 years with JP Morgan and Goldman's. And that's where my first interaction with digital assets began. And essentially in 2017, our clients started to come with the question like, hey, we are not exposed to this, if you can call it a new asset class, but I've been missing something. Do we have to be there? And GS at the time took very constructive view, saying it may evolve in the new asset class. It will remain volatile for the foreseeable future because as any new technology, it will go for this early stage of adoption, and the price discovery will be a painful process. So it's perhaps not for everyone to take exposure in that asset class. If you can take a long-term view, having understood the underlying technology, there is significant appreciation potential. On the other hand, if you can trade the assets, that's a beautiful asset class to be in if you can trade vol. And that triggered my entire interest to the sector. And I have to admit that as many of us, I had been rebuffing the whole idea of crypto for years before that. But having immersed myself in the underlying technology, I just came to appreciate the beauty of underlying math and the whole concept which allowed this distributed system, decentralized system to exist. And you would remember that Leslie Lamport back in 1980s, the famous American computer scientist, described this idea of how do you handle a decentralized system when you don't have a central command, right, structure. In decentralized, how do you find this consensus mechanism between parties involved? And he described this famous Byzantine general problem, which at the time did not have a solution. And actually the solution was brought only by blockchain many years later. And having now solved the double spend problem, suddenly you have completely different structure, which now can kind of exist in the world in decentralized manner. So I went back to Oxford, did a course, what's called Oxford Blockchain Strategy course. Essentially, MIT would give you a technology component, and Oxford would force you to think how it can impact your existing business, in my case, banking, or what potential opportunity the whole blockchain can create. And that's how my journey started to digital assets. Essentially, I thought...
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
What potential opportunity the whole blockchain can create. And that's how my journey started to digital assets. Essentially, I thought this is, however small at this time part of the financial world which is likely to expand, and we are likely to experience the highest growth for the foreseeable future coming exactly from the digital asset space. And from here, I was lucky to meet two of my partners with whom we went to set up Nickel Digital. And the fundamental idea was there is a gap in the market between traditional finance and crypto space. Specifically, those funds who are in existence, who were in existence, either they are not regulated or they operate in a semi-gray area. And of course, this is not the way for institutional investors to access the market. And that's how we decided to address multiple concerns of investors just to create this transparent access to crypto market. Essentially, our philosophy is let's build a bridge between these two worlds in an efficient and transparent manner. So two of my partners, they came also from a traditional background. Michael has been in business of market neutral ARB on fixed income for good 20 plus years. And that's exactly how we apply the same technology now to crypto world. And we'll discuss it later as to what exactly we do. And my second partner, Ali Claude, he did maths in Oxford, econometrical economic in LSE. He's more statistician, mathematician, macro guy, and then worked for free hedge funds, went back to PhD program on macro and volatility, and also ended up researching this space. So when three of us, we met, we said like, we can build something and create this bridge, as I said. And our very first, well, perhaps let's say issues we were trying to address. First, regulation, and we became the first FCA regulated crypto ARB fund in London. Second was custody problem. And we thought you may have as an investor a view on crypto space. You may be willing to engage, but unless you have security around these assets, you will never engage, right? And we thought there must be a solid solution on the custody front. And I believe what we have today is perfectly, it would tick any box of any institutional investor. And then the idea was, let's bring a very strong team, again, coming from traditional finance, and then apply this experience now to crypto world. And finally, let's put together a first-tier service providers to provide a very solid, transparent type of operations, and by virtue of that, comfort to the incoming investors. And today, our KPMG is our fund administrator, auditor. Trident Trust is fund administrator, Fidelity is custodian, and generally, it's a very transparent and well set up structure. So that's what we are building today, is a full service asset management house, providing various access points to the market, starting with a market neutral arbitrage, whereby you're not taking view on the market, but instead you are exploiting inefficiencies, price dislocations, and volatility of this market, and all the way to more directional strategies.
Let's maybe go there in a second, because it's interesting how you arrived at the point. 2-3 years ago, you left Goldman's together with your friends and now business partners to form what is now Nickel Digital with, 20 people, 25 people, something like that. But it's no longer a small shop, right?
That's correct.
And so the decision that I guess you had to make at some point is, what are we going to do? Are we going to be in the tracking, providing exposure space to either Ether or Bitcoin or like any digital asset that you are able to track? Or are you setting yourselves up more like a hedge fund, arbitraging, trying to generate alpha? We'll go there in a bit, but I'd like to take a little bit of a segue, because you've just mentioned custody and you've also mentioned institutional investors. And I think that is interesting, because it is an important, very important puzzle piece, is custody, right? Like all the people that kind of like started trading in Bitcoin, say early, I first got exposure to Bitcoin in 2013. And, I tried to understand what a wallet was, but it was difficult, right? Everything was left on the exchange. I didn't have a hardware wallet. But, when you leave your Bitcoin on an exchange, essentially what's happening is that you have an IOU against that exchange, because it's kind of like in that omnibus wallet, right? And if something happens, a hack, then you're exposed. And then we moved over to hardware wallets where you keep your own private keys close to your chest. But that's not what you're doing. You're using an institutional grade, whatever institutional grade means. I mean, many people mean many things with that maybe, but for a professional investor that wants to, get a larger amount of exposure to that market, the custody piece is really is key, right? So how does that work? And how do you do it? And maybe when you speak about it, you can also explain what the multi-signature elements of your custody solutions are.
Absolutely. So our thought process was, unless we can deliver a solid solution, we shouldn't be in this business at all, right? And you rightfully mentioned the hot storage, hot wallet. That certainly wouldn't work for any substantial amount of money. You cannot take potentially this counterparty with the exchanges. The cold storage with self-storage with the small device like Ledger or Trezor, which you plug into the USB. Certainly, when you've done your trades and you unplug the device, you have created this air gap with the internet, and hypothetical North Korean hacker cannot get to your private keys. By virtue of that, the key is safe. However, what prevents you from disappearing with this device? And by virtue of that, carrying $500 million with you, right? So basically, once you enter fiduciary management, that solution is not appropriate. Institutional investors should not really be comfortable with that solution. And situations with Quadriga in famous exchange in Canada shows how people can disappear with $200 million. So our approach was, it has to be an independent custodian who holds these assets, and we have to address what is called single point of failure. No single entity should have full control over assets. We need cooperation between few parties involved in order to move the assets, and that creates resilience to the structure. If you allow me, I'm going to show you one slide. To the left of the screen, there is a sharding model. So essentially, what is the private key? It's a 64-digit long alphanumerical code. And what we do, we take this key and we cryptographically shard it into 3 pieces. And then these 3 pieces are distributed between 3 parties involved. One being investment advisor, I keep one of the part of the key. Second is the custodian. And the third one is the fund administrator. In our case, Trident Trust. Now, in order to move the key, you have to combine these pieces, or to move the assets, you have to combine these pieces to recreate the master key. And that creates, we have to cooperate with other parties. Now, interestingly enough, you need only two parts of key rather than the whole 3. The question, why not 3? 3 potentially would create a more resilient structure. But the answer is no. If you need all 3 parties to be present around the table, you weaken the structure, because if one party is missing, you cannot access your asset. So from that perspective, when you have 2 out of 3, you can simulate a situation whereby, say, a custodian goes out of business. That's perfectly fine. Jointly with fund administrator, we have 2 pieces which recreate the entire key, and we can move these assets from one custodian to another. By the same token, if I, as an investment manager, start to run operations which are not part of my investment mandate, fund administrator, jointly with custodian, can withdraw the asset without asking my permission and without my consent, and return this capital back to the investors. And what its system creates, this transparency and accountability between amongst all the parties involved. Now, one of the questions is like, hey, how can you recreate the entire key using only 2 bits? And the underlying is a beautiful math, which essentially can do this trick for you. All the sharding is based on so-called Shamir sharding protocol, which is very famous Israeli cryptographer. I think that initially was invented for the military purposes, but ultimately became part of the crypto community. But yes, it allows you to recreate the entire key just using 2 parts. And essentially, you can do n out of n plus 1. You can do 5 out of 6. Or 39 out of 40, if you want to go on this complexity. It's just perhaps unnecessary complexity.
All right. So the custody piece is really important to get the institutional investors' consent to actually get exposure and make an investment, right? But now Nickel Digital, you are not only in the business of providing tracking exposure, and there's a couple. I know in the US it's still problematic. We're waiting for the ETF. The Grayscale fund exists, but it trades at a relatively constant premium of around 35%, I think. There's futures markets for people to get access, but the basis in that futures contract is almost equivalently high, depending on demand for it and for Bitcoin. And then you have ETPs, or essentially ETCs here in Europe, which have become regulated, and by the way, which are growing really, really fast. For instance, there's one by the Bitcoin Issuance Group, I think, trading on Xetra in Frankfurt, and it's the second most active ETP on their platform. Recently, it's attracting millions and millions and millions of euros every day. So certainly there's something on the way. But you're not only, and you can tell us about how you solve that tracking problem, and you're in that business for a long time, but also what you do in addition to tracking, which is your arbitrage fund, and how you go about generating alpha in those markets.
I think it's fair to say that our core business from the very beginning was really market neutral ARB. And our logic was, this is the most difficult product to bring to the market, investment solution, because it's a low latency product. You have to trade, it's a cross-venue arbitrage, so you have to trade on multiple exchanges. You have to be mindful of your literal kind of latency between individual exchanges. Sometimes you bump into speed of light as your kind of limitations, but you have to collocate your servers. You have to build powerful risk management systems. If you can do that, and you can deliver sustainable returns, certainly you should be able to deliver less complex products, such as long-only exposure, being trackers and so on. So market neutral ARB was our first implementation, and that's what we launched back in June 2019. We have now 19 months in operation, and it happened to be 19 positive months. It's a very consistent rate of return. We managed to reduce the volatility of underlying market. If you look on Bitcoin, it's roughly 70%, and we reduced that volatility into 1.7%. So basically 70 becomes less than 2. And because of that, the Sharpe of the fund is 5. From my past career, when you see a manager running Sharpe of 3, you go suspicious on them. How is this possible? Here we go, running Sharpe of 5. And that's a reflection of this consistency of returns, right? Now, in terms of sub-strategies, which we are using to extract value from the market, we are deploying very traditional techniques. We're just applying these techniques to the far more volatile market. This is our spectrum of sub-strategies. The triangle shows various risks in relation to each of the sub-strategies, and all these sub-strategies are market neutral. So if you go, what is the naked Bitcoin direct exposure, this triangle should go another perhaps couple of meters, and that's going to be a long-only exposure. This is the other end of the spectrum. And within these individual sub-strategies, the most widely used would be triangle arbitrage. And TriArb is borrowed from the FX market. The logic here is, in the conventional world, you would have US dollars, say sterling and yen, and you start with one currency, move to another, to the third, and back to the first one. In theory, you're not supposed to make money because you would waste on some transaction expenses, but pretty much kind of market is so efficient, it's difficult to extract value. In crypto, you can, because the markets are moving so aggressively on a daily basis. Let's say if you have a stool with 3 legs, in theory, it's perfectly horizontal. But when the legs are moving 5% a day, it's difficult for the market to have perfect synchronization. And that's exactly what we're exploiting here. So you may start with one currency, go to another, and it's cross-exchange, and then to the third one, and you have certain positive delta. So these operations are global. We're trading, as I mentioned, at 17 exchanges, and say this triangle can be a triangulation between Coinbase, LMAX in London, and Liquid in Tokyo. And all these exchanges, all these free transactions are completely unrelated for the market. For us, they are part of the same structure. And essentially the way it works, the whole hedge fund is fully systematic. We don't trade manually. People are too slow for that. What we do, we write the right code, we create algos, and then these algos would monitor the market. Whenever there is dislocation, it immediately fires all free trades. And all free trades can be executed in 100 milliseconds, 150 max. And basically, once you get a report back from these exchanges that your trades are done, you move to the next triangle, and you would do sequentially like 7 transactions a second, and so on, until you exhaust this opportunity, and then you move to the next opportunity.
Let's stop there for a second, Anatoly, because I think that's interesting. So you're essentially describing a low latency triangular art business here.
Absolutely correct.
Now, what about the fees? Right? I mean, most of us mere mortals, if we're not trading millions and millions and millions on Bitcoin exchanges or crypto exchanges for that matter, then fees are pretty steep, right? Yes. The more you trade, the greater your discount gets. But so you must have first of all, you have a sensitivity to those fees. Tell us how you manage that and to what extent that creates a drag.
The way it works, we have what is called consolidated order book, which ranks all exchanges we're trading at. And it takes into account a few important bits of information. First one, what is the price of a given asset on a given exchange? Second, what's the depth of the order book? Essentially, if you throw a million, you will move the market. If you throw 10 million, you're going to exhaust this market, right? And then the third component are the fees of this particular exchange. And when you stack everything together, you can see how you can channel what size of the order through which channels. Now, what happens here that you trade the most efficient channel out there. Fees become an important component, but for the large trades or kind of for the active traders like us, and we are turning the fund multiple times a month, it's a really very aggressive trading. What we are seeing, all the exchanges are racing down the bottom, right, to get your business. And that implies then whenever they fly to see you and negotiate kind of volumes, and the typical conversation would be like, hey guys, it was 200 million last month, and now this volume has dropped to 10 million. And the answer is nothing personal. Just in the consolidated order book, you used to be number 1, now you're number 7, because somebody is offering better terms. And essentially the only thing exchanges can do is to drop the fee down to bottom. And that's how, if for the retail clients, typical trading fees may be anything between 50 and 150 bips, right? For more professional traders, it would be 20 bips. We typically pay few bips. And that's how the fees are really kind of become not a part of this equation pretty much. You have to exploit inefficiency.
Reminds us of the traditional markets, right? Probably isn't going to take long before there are systematic internalizers and dark pools and all that type of stuff operating in the crypto space in the same way that they operate in traditional assets.
Absolutely.
So that one is interesting. You have almost, that's a millisecond type of exposure that you're talking about. But some of the other components, some of the other alpha engines that you have on that triangle that you showed earlier, they're presumably holding positions for a longer period of time and not just for a millisecond or a couple of milliseconds, right? The calendar spreads, for instance, right? Or relative value trades. So how do they work and what? I just want to bring that up because probably 10 days ago, whenever it was, right, we had the event with Ripple and Ripple essentially collapsing, right? That's a tail event. Have you been exposed to that and how do you manage that?
The answer is we're not exposed to Ripple, but we generally would trade top 10 assets. And the logic is, how do we select assets we trade? The answer is there are 8,000 crypto assets out there, but only few of them, roughly 10 to 12, today have derivative market on top of that, and on top of them. And for us, being a market neutral play, we have to have a derivative market. Essentially, I need to hedge every single crypto position I have in my portfolio. If I take $20 million and convert it into 20 million Bitcoin, I have to short corresponding future back to back, right? And by virtue of that, my position remains market neutral. Now, how many assets have derivative position? The answer is 10 to 12, and that's our playing field. Ripple is one of those, and we didn't have it in portfolio, but if it was there, it would be still protected. It would be market neutral. We wouldn't experience this negative impact of Ripple going minus 25% on a day. Perhaps the bigger contributor to the P&L is future basis. And here on the future basis, this market can experience significant dislocations between future and spot. And fundamental reason for that is speculative capital would prefer to take exposure by a future market for the simple reason it's capital, from the capital perspective point of view, this is a more efficient way to take exposure. Instead of buying one Bitcoin for 35K, you can buy the same future depositing only 10%. So you need 3.5K, right? Or some exchanges can offer you 1 to 100 leverage, which is suicidal, but still there is a demand for that sort of exposure. What it means to us that when market goes into rally, future tends to experience this higher demand. And that's how it goes into 1, 2, 3, 4, 5% dislocation. And as we speak, March futures will be traded roughly at 5% dislocation to spot. For people like us, who are arbitraging between these two instruments, what we can do, we can lock this profit. Essentially, you go long spot, short future, lock 5%, held it in the maturity, right?
When you say the March future, just to put that into perspective, because this is a fascinating trade, and it's the trade that you and I spoke about, and I actually wrote about it on a website called twoquants.com. But when you say the March future trades at 5% dislocation, March is 2 months away, right? So 5 times 6 is 30. So there's roughly, just back of the envelope, a 30 to 40% annualized yield in that trade, in that basis trade. And clearly it does have a beta to the price of Bitcoin, right? The more Bitcoin rallies, the more dislocated that basis becomes, in my experience, the more contangoed that market becomes. And I sometimes scratch my head because it's like, why am I doing anything else? I should just be doing that trade, right? It makes 30% a year. You can time it a little bit, only do it when you find the basis to be really attractive, and be short the futures contract and long either spot Bitcoin or a security that tracks Bitcoin efficiently without any premium.
That's right.
And by the way, it's going to be interesting to see what will happen to the Ether market because the CME is about to launch a futures contract on that product, right? So we'll see what type of a basis will develop in a market away from Bitcoin, because really Bitcoin is the only one. You have the backed futures contract, you have the CME futures contract, the CBOE futures contract no longer exists. But those ones are interesting. One is physically delivered or delivered into the backed warehouse against Bitcoin, and the other one is cash settled. That's the one on the CME, but it'll be interesting to see what happens with Ether. So anyway, so we have triangular arbitrage, very short-term holding period, milliseconds. Then you have those basis trades, which I presume you hold for a longer period of time, maybe a couple of days, right? Yeah. Give us one more example. You know, your crypto hedge fund, fascinating, interesting to learn how you trade markets.
Yeah, another example would be swap trading. And here we're talking about perpetual swaps, which is this beautiful instrument designed or kind of widely accepted by crypto community. And the logic, as you know, is instead of going into futures, which have monthly or quarterly settlement, and by virtue of that, he's this inefficiency related to rolling these futures. Somebody came up with the brilliant idea as to why don't we do this every 8 hours? And then essentially the settlement between two parties happens every 8 hours. And in order to incentivize other party to join the trade, because the number of longs must be equal to the number of shorts, longs would typically pay some interest rate to the shorts. And this interest rate, base case scenario, is 1 BIP. Now, if you go into free cycle within 124 hours, it's 3 bips. Extrapolate to 1 year, it's roughly 11.5%. So longs would pay to the shorts 11.5%. In reality, this 1 BIP can be extremely volatile. It can be 1 BIP today. In the strong rally, it can be 3, 5, 10 bips in 8 hours. you think like, wait a minute, 10 bips in 8 hours, extrapolate to on the annual basis, goes in 100% a year. And if you can capture that, it's not sustainable. It may be very short-term lived, but you can capture this individual high yield game, right? Now, we by definition are on the short side of this trade, and by definition, we're being paid for holding this position. Why are we on the short side? Because we're holding long Bitcoin, we're shorting it via perpetual swap. And this is another great trade. What happens in the rally, this interest payment explodes, right? And we're capturing this for the yield of the portfolio as part of the portfolio yield. Now you have to be careful. Then when market goes into reverse, then essentially shorts have to pay long to incentivize them to come to the market. In that case, we have to switch our positions from swap back to the futures market in order to avoid kind of paying anyone, right, in terms of interest payment.
So that's another form of basis trading, essentially just using a different instrument, using the perpetual 8-hour swap, something that you can trade, for instance, on Deribit, you can trade it on Bitstamp, on other exchanges, right? And sometimes I see that trading at, say, 8 basis points positive. I mean, most of the time it trades around that, between 3 and 8 basis points is what I see for an 8-hour period, which is absolutely fascinating, right? But then you need to trade it on that exchange.
Yeah, absolutely. Another perhaps thing I would like to mention is volatility arb. So in volatility arbitrage, you would take a view. So your portfolio remains delta neutral. You're not taking market view, but you may take a view that if your implied vol went all the way to 140, it's likely to be unsustainable value. It's likely to mean reverse to something more sustainable. And in that case, you can short a very high implied vol on the understanding that within your horizon of 3 to 6 months, it will revert to more typical value, which is 70, say, right? So this volatility arb, you're looking between kind of this spread between realized vol and implied vol, right? So this is one of the strategy. We would not be engaging this unless there is a massive upside, but as it was in March, when the market went in a massive liquidity implosion, and that liquidity implosion caused market to collapse, implied vol went through the roof. We shorted it at a very high level in order to gain this mean reversion yield, right?
That takes me to a very interesting question that I actually forgot to ask. To what extent are the trades that you're describing systematic, and to what extent are they discretionary? When you say something like, in March when Bitcoin crashed all the way down to whatever, 3,500, something like that, right? And implied vol was at 140. Do you then actually come together as like an investment committee and say, now that's what we're doing. We're now doing vol arb. We're selling vol, we're delta hedging it. Or is there a system, an algo that detects those trades for you?
So the answer is the entire trading is fully systematic. But we have left certain, human overlay around above the system. And the logic is that majority of these trades, which I've showed you, if not all of them, they are algo driven. And whenever the opportunity is there, machine would trade within the parameterization, which we gave it from the very beginning, and within the capital allocation, which was given to this particular sub-strategy. However, if the machine exhausts the opportunity, it would come back to the traders in form of first messaging. If traders wouldn't pick up, it would call. If traders do not pick up the call, then the system may actually kind of put the trade on hold until the attention is given. But the whole idea, whenever the capital is requested, that's a human decision whether to allocate more capital. When machine identified something which is extraordinary, like 3 standard deviation move or 5 standard deviation move, it would actually pause the trading and would ask traders for some critical decisions. But otherwise, in 98% of the trades, it is systematic. But some things specifically was left for humans to oversee the system. And risk management, essentially, this is the human function. We decided that allocation between individual strategies, because there is certain risk management around like how much you can put in the future basis. If there is an opportunity, you want to exploit that, But would you put 100% of your fund? The answer is no. It's limited to certain self-imposed limits. And that's where human traders are taking these decisions. And coming back to March, in March, indeed, it was extraordinary situation. And it was already kind of our heavy involvement, including vol arbitrage. We have taken a view whether at these levels we're happy to short the market, or we would like to see higher values for us to engage. And when market went all the way to 140, 160, we thought it was the right level to short the market. So yes, the human involvement.
I think, Anatoly, you would say that the nickel digital market neutral arbitrage fund, it's fair to say that's your flagship fund. And it appeals to investors who trust and who have faith in you that you can produce alpha by trading in digital asset markets, right? But you also have another fund, which is essentially a Bitcoin tracker. Tell us a little bit about that and how you set that up and how that differs from, for instance, other providers and other solutions out there. We've mentioned Grayscale, which is, has become famous. What do you do differently?
Right. So essentially, the idea of Bitcoin tracker, which we call digital gold for a reason, came from our existing investors in the Arbitrage fund, who came with this question like, hey, we also would like, in addition to the very conservative strategy you are running on ARB side, have an exposure to the market in general. Because certainly if market goes 5x, ARB is not supposed to catch up with this market. It's supposed to deliver in any market environment, but its target yield 8 to 10% in a very sustainable manner. Now, coming back to the tracker, how do you capture this 5x? And the answer is, of course, you go either to ETF, ideally, but there is no ETF per se yet. There are ETPs, like exchange traded products out there, and Germany is leading the pack in Canada. And I'm very glad to see this expansion of the market and various access channels. There is Grayscale, which we mentioned, and Grayscale certainly was a market pioneer by bringing this product to the market 7 years ago in 2013. And by virtue of that, now they accumulated significant amount of capital. But the problem, as our clients saw it was inefficiency around the existing structure. Specifically, what they pointed out, if you look on Grayscale, it's a trust. And by virtue of being trust, there is a small print. This trust is non-redeemable. Whenever you bring $10 million, they will take it with the great thanks, convert it into Bitcoin, and that's going to go in trust. And essentially, small print says, never, ever dare to come back to ask for your Bitcoin. It's not yours. It's ownership of trust. All you get in exchange are the shares of the trust, which after 6 months lock up, or 12, depending on what asset you hold, it becomes now eligible for resale in the secondary market. And as you mentioned earlier, indeed, secondary market is trading at a significant premium. It can be as high as 35%, has been even higher in the past. And the question like, why there is dislocation? The answer is very few people have access to the primary market because it is qualified investors only. Now, on the secondary market, everyone can buy. And that's how retail demand is on the secondary market. And that creates this kind of disbalance. There are too large amount of money searching for relatively few shares which are being thrown in the market. And that creates this 35% dislocation. And if you enter it in the primary market, your exit route is resell on the secondary. You're going to be screwing retail investors, of course, because they're overpaying 35% premium to the fair market value of Bitcoin. But if your ideological setup, it kind of works fine and you are happy to resell it at the massive premium, then the question is, how sustainable is this premium? And the view was taken that, listen, this is what is called a regulatory arbitrage, right? Because you are betting that within the next 6 months, whilst you're holding this asset, there won't be any ETF introduced to the market. Because the moment ETF comes, which generally trades very close to the fair market price, the existing premium will collapse. Because if you think, why would anyone buy with 35% premium when there is a clear alternative, an ETF at fair market price. So which means this premium collapsed down to zero, and some people would argue actually it will be trading at the discount to this price, because whoever buys these shares from you is buying something which is a piece of paper. You can never redeem this against Bitcoin, against the trust. So they're going to be a discount. And for that reason, for those investors who were looking for the long-term allocation to Bitcoin without looking to profit on this temporarily arbitrage, they said, like, listen, we're not willing to hold these assets. We need something which is more transparent. A, we want to hold physical Bitcoin. B, we want this to be traded at a fair market price. And C, 2% management fee, which is charged by many providers out there. It looks like it's actively managed product, but it is not. It's just passive holding of Bitcoin. And for that reason, it should be priced completely differently. And that's exactly what we delivered. So instead of 2%, our fund is charging 50 bips. Instead of lock up 6 months or 1 year, it's a daily liquidity from day one. Instead of unwanted premium or discount and unclarity as to how this asset is going to be trading, what we are providing, investors are accessing this market at the index level without bid-ask spread. So this is perhaps the most efficient way to access the market out there. There is no trading fees. How can we afford that? We're using the whole infrastructure of trading infrastructure, which was designed for Arbitrage fund in order to allow investors to access this market. And because fees we are paying are 2 bips, we're very happy to absorb this cost in order to provide this extremely efficient access to the market. And so that's the efficiency which differentiates our offering to the existing one in the market.
So imagine a large institutional investor came to you, right? Say 300, 400 million, something like that, a massive balance sheet. So I want to get exposure to Bitcoin. And in order for that to be meaningful, I cannot just invest 10 million. It needs to be 300, 400 million, something like that, micro strategy level, right? Yeah. How would you go and deploy that in the market? What are the pipelines? What are the underlying processes that you need to go through? I imagine you're not just ringing up a crypto exchange and you're lifting their offer for 400 million in one go. There's probably a little bit more of a delicate trading process behind that.
Absolutely. If you look on the market, you can either access it via spot market, and with that sort of amounts, you inevitably going to move market, right? So, well, put it this way: first thing, you have to do it via TWAP, so time-weighted access to the market. And the idea here is you don't trade in the spot of whatever 1500 GMT. You would trade over a certain period of time. Depending how large is the ticket, it may take an hour, may take a few days. I think in Micro Synergy case, it took a couple of weeks to deploy the capital, right? But that's how you spread your order. The second important thing is, would you enter the market purely via spot, or you would do it in a smarter way? And the smarter way is fix your price using derivative market futures and then work out from future back to spot. Why would you be willing to do so? Because spot market by definition is much smaller than the derivative market, and it's not idiosyncratic to crypto industry. Look on the conventional market. All markets, derivative component sometimes multiple times bigger than the spot. Same here. So basically, by tapping into a greater pool of liquidity, you are able to deploy your order in a more efficient manner. But once you're in the future, you fix the price. Now you can take longer to work from future back to the spot. What's the end game? You are getting the spot physical Bitcoin, which now goes into storage, but your conversion from fiat into crypto is done now in the most seamless manner. There is no real this market impact which you would have experienced otherwise. Now, what do you need to do that? You need trading infrastructure. You should be able to access both spot and derivative market. And second important thing, you should never ever trade through one venue. If you go through one exchange only, you are just vacuum cleaning all the liquidity at that exchange. Who pays for the show? You pay for the show because you are experiencing this negative price impact. On the other hand, if you are able to go via few venues, you split the order in relatively smaller bits, which are not that detrimental to your ultimate price, and you channel your order in an intelligent manner into the market. And then you assemble it on the other side. But you've entered the market in a smoother manner. We're able to do that just because we have this arbitrage structure behind us. Long-only providers usually are not in arbitrage business, and by virtue of that, don't have this diversity and power of trading system.
So stepping away from trading, and maybe before we close that down, you've called it digital gold for a reason, right? So, and I also remember you have that beautiful chart where you show the price evolution of Bitcoin on log scale over its halving cycles over time. So where do you see this going? Like what do you think is going to happen to that space, to Bitcoin, between now, the end of the year, the end of 2022?
Yeah, I think 2020 has become this pivotal year for crypto, and even that led to FT calling 2020 the year Bitcoin went institutional. Again, for a reason. You had the sequence of events of COVID triggering mass unemployment, which triggered response by the central banks, which can be summarized as let's flood market with money. And if you look today on the dollar in existence, roughly 26% have been created in the last 12 months. Of course, that triggered a demand for the hard assets, which are not easily inflatable or dilutable, right? And Bitcoin just happened to be one of those. And this immutable monetary policy, whereby you have limited number of coins with the exactly kind of firmly predictable schedule of issuance, that's what makes it so appealing, right? And in terms of price evolution, I think the graph which you are referred to, if I'm not mistaken, would be this one. So the way we look at the price action, I think general public usually look at Bitcoin in a linear fashion, whereby you have this spike in 2017 all the way to 20K, and then anything before that pretty much lost in translation. Because when you look on 1,000, 2,000 price point, they're just kind of uncomparably small to 20K. And for that reason, you can't really properly analyze the cyclicality within Bitcoin. Now, if you look on the same price action in logarithmic scale, suddenly you have this insight of completely different picture, because now we're looking not in the absolute dollar terms change, but rather percentage change. And you can immediately see these 4-year cycles in Bitcoin price evolution. And it just happened to coincide with 4 years halving cycle. Now, if you look on this previous cycle, you would see that in 2013, by the end of 2013, market peaked at 1,100. And then it took pretty much a year for the market to correct and went in a deep crypto winter. And market lost 85%. Then it reversed and started to consolidate. It took 2 years for the market to recover to the previous height. And by early 2017, we were back to 1,100. And if you look on the press, the scream was like, it's time to sell because market is all-time high. And the answer is actually, that was the time to buy. The reason being, the market just entered in the 4th year of this 4-year cycle. And that's where we saw a famous rise, which was over 17x from 1.1 all the way to nearly 20K. Certainly, market has overrun itself, and then the cycle repeated itself. So market corrected, same 1 year, same 85%, and then in early 2019, there was a reversal. Market started to consolidate again. And my thinking was, when we were thinking of digital gold fund, listen, this history is likely to repeat itself because this pattern is extremely powerful. And we thought that by the end of 2020, we should actually reach previous height. And interestingly enough, by December 2020, indeed, we crossed 20 and we went up. question, is this time to sell because we are in all-time highs? And my view is it actually might be a time to buy. And I am not Bitcoin maximalist from that perspective. The firm generally is a market neutral. We are market neutral guys. And yet, looking at the price dynamics and the investment thesis of Bitcoin, which is a store of value, we are likely to experience significant growth in the foreseeable future. And it's really driven by this demand from institutional clients. That's what makes this cycle so much different to the previous cycle. So you now have this demand from institutions to allocate to Bitcoin. And I'm saying this is an allocation, not speculation anymore, because this money by definition is sticky money. It's a more long-term view on the asset class rather than an attempt to profit in the next 3 to 6 months.
As traders, we know that history rarely ever repeats, but it does rhyme.
It may rhyme with
itself. The size on Bitcoin is still very low, right? It doesn't have a lot of history. It came into existence in 2009. You have all those models, stock to flow, the lock chart, et cetera, et cetera. If we stay on that trajectory, then by August of this year, right? So 7 months from now, we should have crossed the $100,000 mark per Bitcoin, and we should be at about $120,000. Whether that's going to happen, you don't know that, I don't know that. But I think we both agree that a lot of the people, they buy, or they at least start buying in or considering the digital gold narrative, because it is really something like that. It is a electronic form. It's an electronic crypto-based storehold of wealth that has many advantages compared to gold. And actually, Bitcoin started to run the race against gold. It has already happened. It's just, I think people need to realize that, what they see there is actually as valuable.
Absolutely correct. And I actually warn people I'm talking to, just make sure you don't call it cryptocurrency per se.
Because it's not a currency.
It's not a currency, exactly. Because currency implies an efficient mean of exchange. And I can tell Bitcoin is not a very efficient mean of exchange. You have a very old technology called Visa International, which has been around since 1970s. And this system can process roughly 56,000 transactions per second. Bitcoin can barely do 7 transactions per second. Certainly not very efficient. And I'm saying it doesn't have to be, because the fundamental investment thesis is store of value. And once you deliver on that front, you don't have to be kind of easily transactable. You never pay with the brick of gold for your Starbucks coffee. As a matter of fact, you will not be able to buy coffee with the brick of gold. Same way with Bitcoin, it doesn't have to be a payment mechanism for the everyday settlement, because actually this is your reserve asset, not a currency, reserve asset, to which it's your price reference. And ultimately, at some stage, you may design that as your main, the main asset within your treasury. And by virtue of that, that's your referenced asset. And whether there is a lots of discussion about volatility, like, hey, if it's a store of value, it's not an efficient store of value because it's volatile. And I'm saying, listen, look long-term. Long-term, it preserves value. Yes, it is volatile in the interim, but the end game is worth that volatility. Whether the volatility will persist, it will for the foreseeable future. And then perhaps few key reasons for that. A, it's a new technology. This technology in early days on its adoption curve. And by virtue of that, it will remain volatile for the foreseeable future. Second, you have this inelastic supply. And I think this is the fundamental driving factor behind the price. You have 6.25 Bitcoins released by the system today for each block. And whatever is the demand, it may triple tomorrow. It will remain 6.25. Bitcoin demand goes 10x, it's still 6.25. And there is no correlation between these two things. You look on the computing power, hashing power committed to the network. Again, there is no correlation. The hashing power went multiple times. I think it's now kind of in millions times since Bitcoin was launched in January 2009. Yet The issuance schedule has nothing to do with the hashing power, which means supply is completely inelastic. And you have this perfect asset which reacts to increasing demand. The only balancing factor happened to be price. That's why as the capital flows into the system, it's likely to create this upside volatility. But we're happy to live with upside volatility, right? It will correct itself. Don't take me wrong, very often, because it's going to overrun itself. But that's the nature of this asset. And the last thing on volatility is really kind of size of the pool. Because as my partner Michael is saying, if you take a cannonball and you drop it in the pool, you're going to have significant ripples in the pool. Drop the same cannonball in the ocean, the guy on the other side of the ocean will not feel this water ripples. Why? Size matters. So as Bitcoin market increases in market capitalization, volatility is likely to get lower from where we are today. And that will be another kind of argument in form of now more stable store of value.
So with that being said, I think we both agree, we're not saying Bitcoin will go to $1 million. We're neither saying Bitcoin will go to zero. What will happen, right? We'll just see it and play it as it comes. So thank you, Anatoly, for that conversation. I think it's fascinating. I think 2021 is going to be will continue to be a fascinating year for Bitcoin. Certainly the first 14 days of the year have been very exciting. By the way, we had a more than 20% drop, right, last weekend in Bitcoin. So the volatility is still there. Let's see what happens. Thank you for coming on. I hope I'll be able to see you in person in the not too distant future when that virus is, well, it's probably never going to go away, but we'll be able to travel again. So thank you and all the best.
Many thanks. It was really a pleasure. And the last thing I say for our listeners, have a long-term view on this asset class. As you said, it's likely to be volatile, but as long as your investment horizon, 3 years, 5 years, that's the fundamentally healthy view on the market, and it will deliver. It was really a pleasure. Thanks a lot.
Thank you.
Talk to you soon. Ciao.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.